Hey, this is Leonard Guzman. I'm an enrolled agent here in Los Angeles, and we're going to go over IRS Tax Preparer Penalties. And this is significant because the IRS has been saying that they're going to increase audits, especially with the budget increases, their hirings, and then also their implementation of AI. They're going to audit more taxpayers, and so tax preparers are also going to be audited. So let's get into the presentation. Now, who's a tax preparer? So this is defined by the IRS. So key points are the person who substantially does the portion of the tax return, advice on transactions, who preps the estate plan. And these are people who you hire as a tax preparer, a CPA, an enrolled agent, or a licensed tax preparer, someone who has a PTIN. So the audit of the taxpayer. So this will start by the IRS going to trigger that the taxpayer, took what you call LUQs, large, unusual, or questionable, say, deductions. Some things that always come up are, cars, say like a Lamborghini. I know there's Lamborghini SUVs that are like written off. Boats, airplanes. At the same time, things are coming up, new kind of industries where content creators need to, shoot content on a plane or on a pool where they do it every day and it's necessary and ordinary. So, things of that nature you can, maybe justify to the IRS. And so this will come up, and if you do get audited, you want to be able to justify it, record it, and show that it's necessary for the business. So what happens is it starts after the taxpayer audit's done, right? So the preparer cases are separate cases from the taxpayer. They are related in a way because the tax preparer preps the taxpayer's returns, but they're separate in their cases. Now I'm moving my head here. So the tax preparer penalties, according to IRC Section 6694B, and their mandatory referrals to the Office of Professional Responsibility, which is part of the Department of Justice. And this is the greater of $5,000 or 75% of the income earned by the tax preparer. So common violations that tax preparers have. So what happens is it's a willful attempt to understate liability on the tax returns. So a lot of times CPAs, or tax preparers in general want to make the clients happy so they come again next year. So what they'll do is understate the tax liability on the return, and it is done by manipulating deductions, maybe taking credits that they don't qualify for, or another thing is reckless or intentional discard of rules or regulations. And there are exceptions where, first it's savings exception regulation 301-7701-15, and there's clarifications and exceptions. Sometimes clients, taxpayers will be able to justify certain deductions. Maybe their particular business needs certain, like a bigger home office. Maybe their business is in RVs. So sometimes, there's things that are just like outliers that the IRS will question and audit. And there are exceptions where, if it's in good faith, the IRS will make the exception. Now, things to remember. So, the Internal Revenue Manual with Decision 2, the OPR, it's not an issue for negotiation with a taxpayer practitioner. It's kind of like a hard no as far as negotiation. So it's really the only really safeguard is to have due diligence in the tax prep, because that's what the IRS is going to look for. They're going to, when you get audited, they're going to examine the records, and, the tax preparer has to be able to justify it. Now, when the IRS does audit you, there will be sort of like added liability when the tax preparer represents the taxpayer at the audit. And in a way, it's added liability because they could incriminate themselves, whereas the best thing to do is to hire separate representation for both the taxpayer and the tax preparer. And this is in best practice because, or it's best for their interest, because then it won't kind of collude, and they'll be able to have the best result separately.